Welcome back to Let's Talk Tax. I'm Dave McGuire. In today's episode, we're exploring transfer pricing, why businesses overlook it, and how their CPAs can help. Joining us is John Bodur from McGuire Sponsil's Global Business Services team. Welcome, John.
Glad to be here.
So, John, as businesses grow and we think about transfer pricing, now, I think one of the areas we talk about it a lot is as they're growing internationally in cross-border transactions. And actually, right before this, you were pointing out it's not always just about cross-border transactions, but that transfer pricing is needed. Can you expand on that? Give me a little context what you mean.
When we have a company that has, multiple locations, even domestically here in the U.S., and when they have a cross-border transaction, let's say the group headquarters is providing the administrative and back office services for the group, and how that expense allocation should work for each state, each subsidiary that the parent company owns, that is within the lines of transfer pricing. And we see that more and more in the past, I'm going to say 12 months, that domestic companies are seeking to get their intercompany benchmarking done.
Now, I'm going to take a step back before we really dive into it. So obviously, you're kind of the expert in transfer pricing sitting here, and we're going to have people watching that have differing knowledges. So just give me a basic idea. What is transfer pricing? Why is it important? And kind of take a step back and pretend I have no business experience at all. What is transfer pricing and why is it needed?
Transfer pricing is the method to justify intercompany transactions and benchmark those intercompany transactions according to the third-party data available on, in the market. And it's crucially important, and the reason for that is that's how you allocate your, expenses, your profits, and it directly impacts the bottom line. And if you're IRS and if if there's a company here, let's say you would want that company to have as much income as possible for you to tax that firm. And transfer pricing basically provides the guidelines and the benchmark for what the net income should be according to, functions, assets, and risk analysis for the group and participants of the transaction.
So just kind of me thinking about it in my simplified mind here. So I've got a U.S. company, pay taxes in the U.S. I've got operations somewhere overseas. Maybe that's doing my engineering, but then I'm doing my manufacturing somewhere else, and then I'm bringing the products back. Really, the transfer pricing study is just to make sure that I'm charging each different organization correctly so that the U.S. knows how much income I can get taxed on?
Correct. Third party and external example, more likely than not, if everything is to be, according to the standards, in a transaction, the company that assumes the most risk has the IP and intangibles that's contributing uniquely to the group's profitability and revenue and whatnot. You would expect that company to have the most amount of, profits. Mm-hmm. And that's a simplified and a high-level example, but there are certain cases, and even if, large companies such as Caterpillar, which we have a blog that I wrote online, that a 2017 case that they were shifting around 40% of their net income to Switzerland, whereas they had, 5% of their workforce in Switzerland. And obviously IRS took an issue with that approach. So that is a high-level example, but that's what transfer pricing determines.
How often do companies need it? When do you see that a transfer pricing is needed? Is it obviously your example you just gave? That's a big multinational company. A lot of the people we deal with, and I know a lot of the people you're dealing with, aren't of that size. How do we determine when it's needed?
This question has been asked almost any client that we assist in transfer pricing, and we give them two answers. One of them is the book answer, and the book answer is IRS does not have a material threshold. If you have a single dollar of intercompany transaction, which you're reporting this, by the way, on your 5471 form and 5472 form, you're required to update every year. And every third year, you reconstruct the whole study. Our answer to our clients that we work with is to have more like a common sense approach. What we do is we touch base on the anniversary of our delivery of the study with the client, and we want to understand if there had been any significant changes to the operations, to the what the functions that entities involve doing, and assets moved or whatnot. And if there's nothing changed, we tell them that, okay, I think this is the book answer, but for a common sense approach, we can maybe defer for another year. We don't want this to turn into a burden on the taxpayers.
So you said that if there's a 5471, 5472 type situation, that's what triggers it. Is there a compliance risk for not filing those forms but I never bothered to do the transfer pricing? What's my risk there? Why would that be important?
So there are countries right now, Canada just joined this group in terms of basically requiring to have a transfer pricing study and submitting it with your updated return in Canadian tax form. There's a box that you check that says that you have a updated transfer pricing study. Mexico does not accept your tax return unless you have a transfer pricing study that you're submitting with the tax return. That's an exposure. And, there are other countries like Finland, like Sweden, in the Europe as well, that they have this type of practices that if you don't have the transfer pricing study, your tax return might not be accepted.
Is that a growing thing? So that's recent in, I think you said Canada and Mexico. So that's not always been the case?
That had not been the case. And this has been a growing trend that we were able to see while we're working with different, countries. And like I said, U.S. will join at some point.
So you think the U.S. will eventually have some type of requirement to include the transfer pricing study?
Absolutely. So in 5471, there's a schedule called Schedule M that the taxpayer reports the intercompany transactions within the group, and 5472 form Part 4, you disclose the intercompany transactions. There's going to be a time, and I don't know when. I'm assuming it's going to be soon with all the artificial intelligence usage and whatnot. But there's going to be a point that they're going to be sending these automatically generated notices when you have a number in your 5471 schedule.
So right now I'm supposed to have it, but they don't require it to be shown. You're thinking in the future it's going to be required to be shown.
Correct.
Okay.
That creates a confusion sometimes with the clients that we work with, that they're required to have it on hand, but you don't have to submit it. It's interesting rule.
Yeah. Now, with transfer pricing studies, so is it just merely a compliance risk, or is there planning that can go into it? Now that I know this has to be there, is there any type of planning or anything else I can use this for, or is it just I have to have this on my file, so it's a cost?
So compliance is a part of it. If I say no, it would not be accurate. But especially in the last 9 to 12 months, that we saw a lot of the clients that we work with, they're utilizing it as a strategy in terms of cash flow management. So what happens is, when I say cash flow management, we provide a range for the transaction that we're covering, and they can go, within that range. But depending on what they want to accomplish with their cash flow, their corporate goals and whatnot, we can move from, the 30%, let's say, to 10% for an intercompany sales of goods, depending on what country that you would like to leave the cash more or, less.
So sounds like there's some flexibility in how you would do that depending on the country?
Correct.
Now, how do other global events influence that? So I'm assuming it's affected by, let's say I decide to move operations from Canada to Mexico, or Mexico to Europe, or moving things around. Does it affect the cost of goods that I'm moving around? Obviously, this year we've had up and down tariffs and other things. Can I affect the charges I charge between the companies to use as a planning tool, or is that?
If you move your production, for example, from Canada to somewhere in South America, let's say, obviously that is going to have, a different margin.
Mm-hmm.
And we will be benchmarking according to the geographic location of the entity that will be, manufacturing those goods in your example. And that plays a role, how to determine those the ranges that I just mentioned about, whether this is North America or South America or whatever the case might be. But that plays in, 100%.
As you're going through this, I'm sure you get a little bit of insight as to where it's more expensive to do business, where it's less. So you probably get some interesting insight as to operations. And when you're reading the newspaper and you hear, oh, this company moved their operations to Bangladesh, you might have a little bit more insight as to why than somebody like me that is not.
I think that's one of the coolest parts of my job, that I get to do these benchmarking studies, that I get to learn about the clients' businesses, learn about their supply chain, how they operate, what kind of products or services that they provide, but also benchmark those according to their region and compare their margins to what I find on the database, and have an understanding of manufacturing businesses in India versus manufacturing business in the United States and the margins.
You used to think that obviously people had these integrated companies where you would manufacture everything in one building. It seems like more and more companies are just pulling different things from different parts of the world and have massive supply chains to get things done. So I'm sure these are not getting less complicated.
No, you're right. And as the economy of the global economy becomes more global, and you go to different countries for different resources to produce this cup, let's say, it gets more complicated. And it's like I was mentioning, you need to have an analysis of the functions and assets and risk for each entity. So the more entities involved, it gets more complicated.
Now, you mentioned earlier that this isn't always just international, that sometimes companies need this for intercompany transfers, either between different states or different business units and other things. Why would somebody care between different business units? For example, why they're being charged? Is that still a compliance from the IRS side, or is that more of a internal accounting or a state income tax? What are some of the reasons that we would have to worry about that?
I think state income tax planning is one of the top reasons why we had done domestic transfer pricing studies. I don't want to say that compliance is not a part of it, because it is. If an organization has $100 of income, they would prefer to recognize that income at a place where there's no state income tax versus, California or New York, where they do have state income tax.
Are you seeing any of those states increasing their reviews, or similar to the IRS? Is there an expectation that at some point in the future they might, to make sure people aren't trying to offshore, or not offshore in this case, but transfer some of their income down to a lower tax jurisdiction when they're in a higher tax jurisdiction like New York or California?
Especially so, we had done multiple studies we work with clients that had offices in California, but they had recently moved their headquarters to like Texas, for example, and they still had operations in California, but they were trying to allocate the income in between those two states, and that becomes crucial in terms of how much state income tax that they'll be paying.
Okay. Are there penalties associated with transfer pricing, or is it just simply a compliance issue going on? Or what's the risk if I don't have it, but my numbers are probably pretty close?
So this is interesting, because I'm not sure if this is happening in any other tax area that I have never seen this, but how IRS approaches is let's say you have a management fee that you're paying from, a U.S. parent to Irish subsidiary. And let's say we're paying a management fee to Ireland, and you don't have a transfer pricing study. What IRS does is they will benchmark that transaction for you, and they will basically enforce those margins to be included in your financials, and you'll pay taxes on the ones that, the income that you didn't pay according to their benchmarking. And then there's a 20% additional penalty that you would pay.
Can you argue it at that point, or is that once you don't have it, they're just going to set it up for you and you're out of luck? Or can you take that and argue that in court that, hey, the IRS benchmark was too high?
You can, but it's still going to be a challenging process. To begin with, you did not have a study in hand. That's not a good start to begin with. And once they send the taxpayer a notice, they require to have a study in 30 days to be submitted to the IRS, but then still they can challenge. But at least you're starting, when you have a study in hand, you're starting at a different point than when you didn't have.
Well, it's interesting the way you described that. The IRS benchmarking, if they don't have it, I know we have a property tax group. It almost sounds like property tax where they're coming in and saying, here's the value on your house. And if you don't like it, you have to push back a little bit. And it's always harder to come in from an argumentative than a defensive position.
Absolutely. And not to mention, they're going to try to benchmark that transaction as beneficial as possible for the IRS's purposes. And I don't think taxpayers would like that.
Now, do you have any examples of clients where maybe they weren't in compliance with this, or you've gone through and been able to either save them some money by finding things during the transfer pricing or just get them back in compliance after years of uncompliance on the transfer pricing side?
There is a client that we recently worked with. They had a U.S. entity owned by a Canadian parent. And they had been in existence in the U.S. for 10 plus years. And they never had a taxable income where they're producing $3 million of revenue and every single dime of U.S. company's profits were being repatriated to Canada with no documentation or whatnot. So we explained them that this is, the operations is happening in Canada and it's great, but there's a purpose of this entity in the United States, which is generating $3 million of income. So we need to have a taxable income. There's a purpose of that entity. And after 10 years, this year is the first year that they are having a compliant tax return that has a taxable income. Yes, they are going to be paying some taxes. But again, when you have an entity that serves a purpose, that generates revenue and has zero COGS and every dime is repatriated, that's red flag, like first class red flag, as I would call it.
Before we kind of conclude this, are there any other examples or client stories that you want to share?
We recently assisted one of our alliance firms on an acquisition, and tax diligence was a part of it, and transfer pricing was a piece of that part. And we did a study to basically confirm the intercompany sales of goods was in compliance and the margins that they used were good. Mm-hmm. And that was a retroactive. And proactively, we discussed how can we maximize this new, range that we provided according to the new owner's goals and what they want to accomplish, where they want their cash to be and whatnot. So there's a lot of strategy that were discussed during those meetings.
Well, it's interesting. I think as businesses grow, I think we're seeing the complexities of the world changing. And if one thing taught us over the last couple of years is as we've seen these tariffs and everything else, whether you agree with them or disagree with them, it shows how integrated all these businesses are just in international. You've got tentacles kind of everywhere around the world. And I think we've learned that. So it's good to know that there's people like you out there that kind of understand the complexity and can help walk people through this, especially, obviously, we deal with a lot of CPA firms. Those mid-sized CPA firms that may not have an expert on staff like you, knowing that they can call you and ask these questions is probably very gratifying to them to know that they can have somebody to lean on in those situations.
It is, and their clients are very satisfied with the results that they get. And I think one of the things that I was able to observe in the past 12 months is the clients that we're working with, they're really happy that there's an internal benchmark for these transactions, beyond compliance, beyond strategy. They know how they will be recording those intercompany transactions. That's not at cost only, and they understand the logic behind it, and they were able to apply it to their businesses, which makes me happy.
I appreciate the fact that there are people like you out there, John. Thank you for joining us today. And I think for people that are watching today and curious about how McGuire Sponsel supports it, I know you'd be happy to take phone calls and reach out and work with anybody, but anybody that has any questions about transfer pricing and the complexities within, I would ask them just to reach out and talk to somebody at McGuire Sponsel, and we can help them out. But thank you for joining us today, John.
Thank you so much for having me.